Okay, this week's podcast episode is How Do Banks Assess the Creditworthiness of Your Business? And I'm thrilled to introduce Shawn Sackman, Commercial Banking Leader for Regions Bank, which provides financial services such as financing, depository and investment accounts, treasury management, global trade, and the capital markets. Prior to Regions Bank, Shawn was Middle Market Banking Leader for South Florida and Market President for Broward County for Truist Bank over an 18-year career. Shawn, I'm so thrilled to have you on the show, man. This is going to be fantastic. We have known each other now for probably close to a decade. I've always enjoyed our interactions. You always got a great personality. You bring light to the room, so this is going to be great. And I know you want to kind of share your wisdom bites. This is going to be great. So thank you for this. This is awesome.
Well, likewise, thanks for having me. I could listen to your voice all day, and ultimately, for sure, I have loved, respected not just your work, but what you do with these podcasts. I think it's great for the community. So thanks to you. Thanks for having me.
Oh, great, Shawn. So let's kick it off. More of a general overview. So, can you provide an overview, Shawn, of the process that banks use to assess the creditworthiness of a business?
Happy to, and I know you have a broad audience. And I've covered over 20 years, small business to middle market, and I've done every transaction within it. Also covered government and not-for-profit. So I will try to cover as much as I can. If you want me to dive in one space or another, please let me know. And so your listeners know too, I'm speaking on behalf of just what I've known from banking, not just for Regions, but my experience over banking, and I want to help. And so I want to share my knowledge. So a lot of people just don't know, and some of it's foreign. I want to try to speak as clear as I can and direct, so business owners can pick it up and maybe listen to it a couple of times to get different nuggets. But all banks, they have a risk rating system, so they assess their risk based off typically the last 3 years of financials, and then get an interim period or even look at future trends or budgets. And that's the typical majority of companies. But the small stuff, sometimes they'll just do a credit rating, and that's for efficiencies and ultimately to get quick access to the markets. So typically a financial package you'll have, and I think we're going to dive into some of this, Richard, so feel free to stop me. It's last 3 years financials, interim statements, and then there'll be a couple more things like AR aging and inventory. But that's the first step of the process, and they call it a risk rating, which is based off your spreads. And then from that, they'll dive into, and we'll go into some of what that actually the granular detail is. But that's like step one of the process. Once you have that, banks can kind of know, is it a pass, is it a strong credit, a poor credit, and you kind of navigate the creative side of the statements.
All right, so we're going to delve into those risk factors. But so what are the key factors that banks consider when evaluating a business loan application?
And all very similar, from community banks to large banks. I mean, it really starts with cash flow. If there's no cash flow, you can have the best collateral, you can have the best personal guarantors, but it's very hard to do those things through a commercial bank. So cash flow is based off EBITDA. For those who don't know, it's income plus interest, depreciation, and amortization. We would exclude the taxes or put it back into the denominator if you don't have it. But ultimately, it's cash flow. So it starts there. But then from there is what I mentioned in the financials, are historical and future trends. I think where some business owners may struggle is saying, I have this great opportunity. It could be somebody as big as a Walmart, or they're a super big center. But it's it's ultimately gets you, the historicals will be the baseline. The future is another stepping stone, but you can't get the stepping stone without having some baseline. And that's where I think a lot of people say, I have this great contract, how do I get there? And it's not commercial banking. It's usually a form of equity, or there's a little non-bank financing that's out there. But ultimately there is a baseline from it. And then ultimately, assessing to what the ask is. I think a lot of people have a hard time knowing what to ask. And I hope Richard would dive into that too, because, I think some people can relate to when they get a house. I'd love to have a huge house, but I can't, financials can only afford a certain amount. It's very similar with commercial banking, but it's a little harder to understand because they have a lot of moving parts. And we'll dive into what that looks like. It could be a line of credit, a term loan, equipment, right? There could be a buyout, a shareholder. And so it's much more complicated, but it's the same mindset or principle. And it's what you have historically, and then what's the earning potential going forward.
Got it. All right. And so the financial statements, Which ones are most crucial in your credit assessment and why?
So again, go through the gamut, and I'll start from the basics. So tax returns for the small business owners, and very important. Actually, one nugget for them, which I see as a hurdle for a lot, they'll try to minimize their net income for taxes, which we all can understand that. But from when the banks get it, they will not add back it. For example, if you bought $100,000 truck and one-time expense, and you amortize over 5 years, you took 100,000 that year, that's great for taxes. That is not good for cash flow and for banking. And so that's a very what we see a lot for the small business owners. So a little tidbit there is, if you're going for a loan and they're going to go the following year, be mindful, maybe take, amortize 3 or 5 years and ultimately minimize taxes a little bit, but then ultimately make sure you have some cash flow to help evaluate your ask.
Got it.
So business tax returns, and then the typically depends on your exposure, not so much your revenue. So up to 5 million, you can have compiled statements. Over 5, you have reviewed, and then once you get over 10 million, it's an audit. And ultimately, that's the trajectory of it. You get some of the big business owners that are part of here have a quality of earnings. Eventually, if there's a potentially sales side or some big acquisition happening. But that's the trajectory. And what's actually very key too, that is a potential trap for some, and again, mainly I'd say the smaller side of the businesses, is their interim statements may be off from their year-end statements with that CPA completed. And what that questions is, do they have the right internal policies or processes in place so that they can match their year-end numbers from the CPA? And granted, it doesn't have to be exact. But if we're trending all year long, we like their interim statements, and all of a sudden they have material loss because the accountant either accrued or matched something that was different from the accounting system than the company did during the year, that is a question mark or a red flag, potential red flag we can now need to dive into. What caused that discrepancy from the interim statements? Was it a process? Was it the way they looked at a certain accounts receivable or payable could be? And that's just a question. If it didn't happen, there's no questions, and that's great, right? You keep going on to the better conversations. But if it's not, it's another question credit then dives into to make sure that they have the right systems in place.
How strict is that, Shawn, in terms of 10 million in revenue and having to get an audit? What if the company is in that kind of period of time where,
You
oh
sound
my
like a
God,
CFO, Richard.
I got to do the first year audit and all this kind of stuff. What are the tactics? I mean, is there anything else a business can do, or is that a hard and fast rule?
Again, and I'm trying to navigate what banks in general. So every
Yeah.
policy could be different. So it may not be a hard and fast rule from all the banks, but so I, I'm questioning, because ultimately, if you have the credit side, my credit mind be like, absolutely, it's a yes, we need the audit. Sometimes there could be steps where you have reviewed and bumping up to it, and then maybe a year later you have an audit. It could be reviewed plus you have a field exam to kind of navigate that year. So yes, I think well, I go back to, and the CPA world will love me for this. I think going from compiled to reviewed is really hard.
Yes.
And that's actually the main sense. Going from review to audit, it's a couple more steps, and they do field exams and audits, but it's not, it is more money. I think that's where they get the questions, but I think people just want them in their space for days, and I get that. But to get 5 million more, or whatever it is, right, a big number, I think it's worth the time to do it. But a lot of people push back, and they push back because of cost and time, and I get that. But there's got to be a balance. So if there's a bridge, I think it's reviewed, do a field exam, and then maybe you can put out for a year. But that's not everybody. So I don't want to put that out there for the world.
I understand completely. And so, all right, so the financial statements are the income statement, the balance sheet, and the cash flow. What other type of financials? You mentioned maybe some projections, budgets. What about a 13-week cash flow? I mean, are these type of financial statements important or potentially help a loan application?
Absolutely. The more you have, the better. I think the budget side, and I think we understand that business stuff happens. It's hard to really predict, right? Ultimately, nobody can predict a pandemic. That's a drastic stage. It's hard to predict if a customer or a supplier comes and goes if you don't know their internal, what the process is going on. The supplier delay, right? Those things happen, but I think it's important that people have a plan. And ideally, really good business owners not only have a 1-year plan, they have a 5-year plan, and it could be, sell side or acquisition or whatever it could be. I think it's important to know that. I think it's important to share that whatever that thought is long term with your partners. But going back to, and I'll start with the last thing you mentioned, the 13-week cash flow, I think is ideal for a company. And I think to manage their day to day, because if you don't have a 13-week cash flow or not know where your cash position is, all of a sudden you may have a, I don't know if we're on legal, we could say, oh crap moment.
Yeah.
To then like, yeah, how do I then get payroll? And all of a sudden that's a very different, and hopefully not of your listeners get to that situation. The only time I've seen so much of 13-week cash flow is if things are getting troubled. So like we see the trends negatively. So it's not on the upfront of the application. It's more later down the road when you have a relationship with the bank and they want to make sure that you're doing those things. It's just to help keep you accountable and ultimately make sure that is going in the right trend. But after financial statements, the typical is AR aging, and an inventory report, and then the accounts payable aging. And this is actually maybe important, if we can touch a little bit on this, is the line of credit. I think everybody asks, I want the most I can get. You hear a lot of people like, whatever you can approve. And just so you know where the baseline, where banks start is, you have working capital cycle. So there's usually a potential gap between your AR inventory and then where your accounts payable is. So to try to maybe make it as basic as I can is AR, if you have terms that are short, is good because you're getting cash in. The opposite, if you have accounts payable and you have longer terms, that's actually cash that is a source of cash for you that you can use. But if it's flipped, if it's 90 days you're collecting and 30 days you got to pay, all of a sudden you have a 60-day gap. And that's typically where lines of credit come in to help you bridge the gap without even considering inventory yet.
Yeah.
And how we get that number is we want to understand your working capital cycle. So banks will ask for terms. Once they get to your AR and AP aging, they want to make sure everything's in line and current. But then we want to understand terms and see any concentrations. But once we get that, if you just take AR times 80%, will get you your plug number, and that's what banks will margin your AR. And inventory is at 50%, and this is all generalities, and that'll get you your number. You add those two numbers, the AR margin and the inventory margin, kind of gives you a baseline to know what you potentially could get in a line of credit. From that, ultimately then comes is there concentrations? Are there cross agings? Is there more inventory than AR? And that's where things get maybe reduced. But if you want to know what can I look at, that's kind of on the balance sheet side of a working capital where it can play. You take that number and then go back to cash flow, which is step one of a bank to make sure there's cash flow. But that's how we kind of assess where that fits in the range. And so even though you may submit an AR aging inventory report, AP aging, you may get a lot of questions from banks. The banks ask those questions. I actually like that banker because they're trying to understand your business, and everybody's different. Everybody's different terms, and they may have a Walmart or a Target or somebody big that really puts pressure on their working capital, or somebody may have some great relationships for 20 years and they're saying, no, we're paying a discount 2% 10 days no matter what, because they've been a 20-year supplier. That's great. So it's just understanding that process that sometimes those reports don't always get there.
Oh, wonderful. Okay, now this is great, Shawn. No, thank you for this. So if we get to the point that, so cash flow is first thing, and then of course, the bank just wants to know when they're going to get paid, and is there
fair question? Yeah.
Secure. And so does it matter if it's an asset-based lending relationship or it's a cash flow type relationship? Do the banks still look at what their cushion, what their margin of error is, right? I mean, in terms of the cushion between AR and inventory, do they still look at that irrespective? Because even if that's high, but the cash flow is fantastic, do they still look at both of them to fund the application or not?
Yeah, that's another good question where I think some people get hung up because they say have all these assets, they may not have the cash flow, or they have the cash flow and not the assets. And,
yes.
and the answer is it's a balance. And from the bank's perspective, they're and maybe you start the foundation is banks have a very thin margin of error to what you just mentioned. And I don't think people may relate that. They say sometimes, they're big bad banks and they're not lending. And it's because their margin, we're the banks get roughly a little over 2% of spread on the loan or line of credit. It's very thin. And if you have a huge loan that goes bad, all of a sudden those little loans you're doing, which is scale for a bank, could get crushed. And so you got to be right, almost 99% of the time, which is hard to do. So it's not like, your business owners are usually making like 30% of their gross margin, and the bank's got 2 just on the loan, not to take the other things into consideration. So the banks are trying to find, one is their cash flow, which is step one in their process. 2 is they want a second source repayment, which is the assets. So conversion of assets. So it could be the AR conversion, or if you have a liquidity or mortgage or equipment, that's step 2 is collateral. And step 3, not for all, but a step 3 is having a personal guarantee. Typically, the bigger companies may not have recourse, and they have enough enterprise value. Maybe we'll get to that later on. That can support just having steps 1 and 2. But the small business, typically they'll have a personal guarantee, even if it's not, they have a ton of liquidity, just as there as support for having what they call a tertiary source of repayment as step 3. And that's the typical standard for majority of the small business loans. As you get bigger, that may change, including even the collateral position would be less as you get up to scale. When I say up to scale, it's 50 million of revenues of sales and above. And especially you get to a certain size of EBITDA, and every bank's different. It could be over 50 million EBITDA, and you rely more on enterprise value and less on steps 2 and 3, because that they have a market to sell the company if you got to that. And that's a whole probably different conversation. But I think going back to what you're asking, cash flow, they look at 1, 2 is collateral, it's a balance of those 2, and then 3 is a personal guarantee. And that's what all banks in especially small business side would look to have.
You're wonderful, wonderful. Well said. Okay, all right. So what financial ratios do banks typically analyze, and why are they important?
So going back to what the cash flow is, and people are saying, oh, cash flow, which, the cash flow statement, that's a great one that not a lot of people know. But I think the typical one is the P&L for people, and is a debt service coverage. So they'll take the EBITDA and then divide it by your debt service, and it's principal plus interest. So depending what loan or line of credit you have, and you want to equal 1.25 times or higher. So as you're trying to navigate, gosh, what can I get? And, as you would probably do in your personal budget, your home mortgage, the same thing for business. And so ultimately, if you have a term loan for 5 years, you do that math. And again, the banks can help you. And if you have a line of credit, it's a little bit interesting, and there's no right or wrong answer here. Some banks may take a line of credit and turn that over 5 years to just determine what the debt service is, or some may just do interest only for 5 years to get that debt service. And there's no wrong answer. And it just really depends too on how the collateral is or how big the company is. And typically banks will probably look at both those equations for a line of credit, because they're really relying on the working capital. If you ever get stuck on a line of credit, banks may look to term it out, and that's why they do that. So step 1 is debt service coverage. And again, all this is now very public, and you can get online. The second is, once you look at the debt service and there's positive cash flow, is then going to the balance sheet. And the 2 quick lines is, one is looking at tangible net worth. So making sure that there is positive equity in the company. And then looking at the leverage. Leverage would be total liabilities over equity, total equity, and actually the tangible net worth. I'll go into why tangible in a minute. And lower the better. So ultimately, if you are above 3 times on your balance sheet leverage, that's high. That's starting to get to a point of like, gosh, how much leverage can this company take? So, and then it goes back to hopefully what I know we'll dive into the industry questions, but rolling stock, if you're a logistics company, you're probably at 5 times leverage. Well, if you're a service company, you should be at 1 times balance sheet leverage. Mm-hmm. And that's just understanding where your company is and what they do. But you as a business owner, why that's important, what's leverage? It's having flexibility in your numbers in case something happens, right? So during financial recession, companies that did really well and fared had low leverage in the balance sheet because they had all this debt or accounts payable outstanding that they had to pay up eventually. So having that flexibility is important. Also having equity in the company is ability to grow. Equity is expensive compared to debt. Typically it's 12% cost of capital if you go through those scenarios. It's probably a different podcast for you. Shane is
Yeah.
talking about that. Whereas your bank debts, well, right now it's actually at like 6 to 7%, depending what you have. So a little more expensive than historical, but still much cheaper than equity. But that's the balance. So tangible net worth, and the tangible, by the way, if you ever acquire a company or acquire something, there's goodwill that has no value to a bank. The goodwill is if you acquire a company and it's over the book value, that goes to goodwill. No, not a true asset, but you have to amortize it off your books. So ultimately, that's why we use tangible net worth, not just net worth. The second, which we're talking about, the line of credit working capital side, is working capital. So debt service 1, 2, balance sheet leverage 3, working capital. And ultimately, if you have more positive working capital, it means it's better. Your current assets minus current liabilities, right? Higher the better. If it is negative, you have an issue. You have a cash flow issue, and then you have to solve for it. And either you solve for it with extending your payables, which can help, or making sure you get your cash quicker, which is AR. Line of credit can help gap that, but the banks typically will not lend to one that's cash going out. And if you don't know where your cash is going, you mentioned the 13-week weeks cash cycle, that will help. But that's then you start to really dive into it. If somebody has a positive working capital and positive tangible net worth, all of a sudden you are flying through the credit process. It's when those are negative and low that all of a sudden what's going on with the balance sheet of the company, and then you're really diving more into it. Ones that have positive cash flow, a strong balance sheet, has a smooth sailing. And granted, I know it's easier said than done. There are companies that have that very strongly, and just here in South Florida, there's some that are not, and they have maybe a good enough equity in, but have hard working capital, and then you help advise and work with them to kind of figure out how they get there. And really good bankers, even if they can't maybe do something, they should help. Like at least for me, I look at, if it's not me, maybe it's another bank or community bank, or maybe it's a non-financial lender. How do you help bridge the gap? Because they may have a great company. They just don't know how to navigate to the scope of actually having a good banking relationship to get there. And truthfully, a lot of entrepreneurs don't have that mind. Like for me, I started off with an analytical mind, and granted, I have a lot of I think positive stuff more than the just the math side of the brain. But entrepreneurs are kind of risk takers, and I applaud them for it. It's great, but there's a balance. And so if you want to get to the next level, you got to navigate through those things. So there is many more that I can dive into. There's AR days in hand, inventory days in hand, and AP days in hand. You go into the back to the P&L margins. So seeing the trends in margins. Typically you see operating margin about 30%, and then EBITDA margin anywhere from 5 to 15 is kind of a range. Trading companies are very small. The service companies are very high margin. So it just depends on the industry. But your goal as a business owner is to increase your margin. It shouldn't just be to increase sales, because you can sell. If you're selling at 2%, then you're doing a lot of work, right? Somebody may sell at 50 million and have 30% margins and 10%. They'll probably get to, I don't know where we go to, Bahamas or some boat, some fancy thing sooner than in life than later, which I think is the ultimate goal. Maybe not for everybody. But there's ways to do it. I think a lot of people just say grow, and you can actually grow yourself out of business. But ultimately, I think grow efficiently to what is your end game. I think usually is to get a big bottom line.
Yeah, absolutely. No, really well said. Okay, all right. And you hit on a good point, because now you're talking about different stages of a business. So in a startup, Shawn, right, who doesn't have predictable cash flow and is trying to find its market, may not have, gotten to a kind of revenue scale that allows it to borrow money. But if an entrepreneur who's starting up goes to a bank, what's the expectation? If they want to borrow some money, what's typically the response from the bank? How do they get past that early stage?
Yeah, well, so the step one is you should most likely, I'll say for all banks, community banks help a lot with this, take a little more risk. And let me give a little separate condition. If there is a relationship with a personal bank and it's a startup, or you just sold a company, right, and you have some relationship, I put that as a different conversation. I think where you're going is the standard person has a great idea,
Yes.
has great business. And typically when it gets to the banks, it takes about a year. You need a year of financials of some stability. And the next step is really the best process is small business or SBA loan. And a lot of people, there used to be I think a bad stigma on SBA. It should no longer be. There's actually three different programs. The two main ones are 7A and helps get a lot of things from equipment to could be acquisition or property. There's a 504 that even some of the big companies use because you can get 90% loan to value, and there's actually a longer term and amortization that apply. So that's usually they go from after a year, hopefully financials and a business plan is needed for the SBA to help get them to step one. But reverting back to then a year prior, they have a great idea how they get there. A lot of people will, some will have another job and this is their side job and they kind of grow from there. And so they do that. Some people will believe in that deal, will leverage their house and go from there. I don't suggest leveraging credit cards because that is a hard thing to come back from. It's anybody borrowing at 20%, it's impossible to repay. But a lot of people, what they do is friends and family. And so they will scrounge up as much as they can from people around them. They'll share their business idea and plan. And that's usually the best, safest, they call it, angel investors or people around them. And that's the typical form of how they start, or they just start very slowly and build it up and don't borrow as much. But once you get to a point where, let's just say you did borrow from family and friends, you get through a year or two, you repay them, and then you go to bank, and then you hopefully bank debt from there on. There is additional debt, which is still not day one. It could be year one. There's factoring. So if you can't get bank debt, a lot of people go factor. The difference there is if you're at 6-7% for a bank, you're call it 12% or so for factoring. There's non-traditional bank lending that don't have the same regulations as banks, and that's probably anywhere from 12 to 15% in interest rate, so a little bit higher. But there's ways of getting there. It's just costly. Your goal should be to get bank debt, which is the cheapest form of debt, but it just may take a year or so to get there.
Got it. Wonderfully. Well said. All right, let's talk a little about credit history and credit scores, right? We know the impact on individuals of having a stellar credit score. So how does a business's credit history impact its ability to secure a loan?
I'm going to give, again, all my opinion. It's probably less than personal in the credit score. The personal credit score, just to give a moment on that, is pulled and ultimately helps to see what debt they have. Is there any bankruptcies? Ultimately, are they just taking the money and buying big boats and cars and houses, and all of a sudden, personal leverage is important. And maybe it's a conversation a little bit later on. The business score, if you're a small business, they'll pull the business score, and ultimately that will punch out a number, and you can go. But when we look at the risk rating, and especially when you get to a sizable, medium and larger size businesses, the banks will make their assessment. And I'll give you a story. Of course, not sharing any names. Looked at a credit, and there was issues that I kind of mentioned between the interim statements to the year numbers, and happened every year. Warned them happen again, and then we end up exiting relationship. Well, that company eventually cleaned it up, but we were, as a institution, didn't feel that they had the right processes. But some bank took them on, not knowing the history for 2 years of their bumps of how to fix this, and it still wasn't fixed. So they were able to take it on, but they didn't know our history because we're private, right? So it's not like we, unless you have a bankruptcy or delayed payments, nothing gets posted to any credit score. But there is institutional knowledge or banker knowledge that may not be, it's not filed because you had a bankruptcy or missed payments. So when another bank picks it up, you have a clean slate, to be honest, as a business owner. And if you can tell your story, what happened in the past. Ultimately, I would say to be as transparent as you can from my side, but maybe there's a way to be transparent of what you're doing to correct and go forward. And mostly in good markets, banks are pretty hungry for good assets. And so that may actually be okay for you. But I would say, and this is maybe worth a touching point, don't ever miss a loan payment or line of credit payment. It does a lot of things that could go bad if and ultimately in banking we say little d and small d defaults. Little d defaults are on conditions, but if you ever miss a payment default or maturity date and don't pay, it's a big D default. And if it ever goes down a path to reconciliation or collecting, assets, if you miss those big D's, you're not in favor of a court decision or litigation, those things. So when it goes down, a little different than a condition if you miss the debt service coverage or financial timely. Those are also ultimately defaults, but small D defaults versus missing a payment, you're in trouble. Like there's that goes down a path that's not usually friendly unless it's a very crazy circumstance, but I haven't seen too many of those.
Got it. No, and you're going down an interesting path and a very fluid path here, Shawn. So, just for the listening audience, when a bank extends a loan, what's the typical position that the bank will take? I mean, if things go awry and things start to decline, just tell us a little bit about the position the bank would preferably take, above other lenders or whomever. And then what's the process typically?
So there stuff happens in business, and I think every business owner gets it. I think smart bankers understand that. The very, very most important thing I can say, no matter what happens as a business owner, is communicate and get ahead of it, even if it doesn't happen. Hey, like this is going on. We may not make our debt service coverage at the end of the year, so we won't make 1.25, but I think we're going to be at maybe 1.05 or 1.1. That business owner came to you in advance and explains, and then not only just saying, hey, we may fall short, but this is how we're mitigating whatever happened if they lost a client or interest rates went up very crazy, whatever the business situation that the supplier chain didn't come in, we couldn't make the sale, is understanding what happened, mitigating it, and then communicating it to the bank. People who don't communicate it and you get a surprise end of the year, that's when, again, you get another, oh crap moment. Then you have to figure out, like, did they know in that share? Was it, what is this something that could be mitigated? And now we're figuring out the fly versus if you understand something happens, which things happen all the time. I wish everybody has that hockey stick and go up, and it's just not the way the world works. I mean, I wish everybody in the world, it'd be like a utopia world if that thing happened, but maybe like crazy world. But stuff happens. I think you got to communicate it, and then ultimately a good banker. And by the way, the banker should be your advisor. You should have advisors with your bank, your CPA, your law firm, and your insurance agent. Those are probably your professionals you have around you. I get it. Small business owners, it's hard to pay for those things, but you should have some form of relationship, even if it's at a small scope, that can help advise. And so when you have an issue, you tell your banker, your advisor, and then that banker should be advocating you internally. Hey, they have a credit team. It could be a local team for community bank. It could be a big one, that are spread out for the larger ones. And they're all, similar process is saying what's going on. And then they say, okay, we will wait till we get the financials. We know this is coming in. And when they see it, sometimes I've actually been surprised. Oh, they met 1.25 because that business owner made some moves to make it happen. Or they're at 1.1 and they get a one-time waiver. And then waivers could be, this is, I think where you're going is what happens after. Once you miss a default, like a debt service coverage, or again, finally, hopefully it's not the payment default, but it's financials timely. And the bank can call default, or ultimately they can have a cure lever that will ultimately waive it. But let's just say December 31st happens, there's a default, and the bank will make a decision at that point. And usually before the decision is made, there's a conversation with the business owner. The one that ultimately informed the bank, it may be something very quick. Hey, things are going on the path. And let me just say too, once we get the financials, usually it's not till end of January, February. So it could be another month past. There's good things happening. That guy's going to get usually a pretty good, easy pass. One who doesn't say anything, and all of a sudden we do our debt service coverage because that's a requirement, and they don't pass, then things start to get a little more hands-on from the banks, and probably not necessarily in your favor. It may not be that they exit a relationship. It could be that you have a lot more bells and whistles on your structure than you had before. And the bank has the right to do that with a default. If you don't default, they go through with your agreement through the life of that maturity date, and you'll go on your way and hopefully growing. But those things hopefully don't happen. Hopefully you continue the path. But I think if you ever do have an issue, raise your hand, talk to your advisor, your banker. Let's figure out how to navigate it together. I've seen my problem, just to give you an example, somebody who profitability year after year after year, during the financial recession, a couple years after, had a loss. And ultimately, we gave a little requirement condition to meet the debt service quarterly in a rolling 12 months. They met it, and then they started to crush it again after that. So it happens, and hopefully that's a positive situation. If you feel like you've had a negative conversation, I would sometimes, like Michael Jackson said, like looking the man in the mirror, and maybe the way you positioned it to the banks, just don't always look at the banks, or it could be the banks had a very not a thoughtful process too. And I think those things are both real.
Absolutely. And you're in the business of trust, Shawn,
Yep.
for sure. This is all based on trust. So my last question on the credit history, and we'll come off that point. But it's important for business to understand that there are assessments outside of the business, Dun and Bradstreet and stuff like that. So just give the listeners a bit of a view as to when banks are looking at the creditworthiness of the business, what outside scores or types of diligence does a bank do?
So, so you talking more towards industry too, or just for that? I mean,
industry as well as that specific, because sometimes that gets lost.
Yeah.
Sometimes payables extend, and then all of a sudden there's a black mark on a credit score or Dun and Bradstreet or whatever. Just give the listeners a view
Yeah.
as to, look, it's not just all internal. There's an
Yeah.
external view to this as well.
Yeah, for 100%. And ultimately, just to give you my view too, once somebody on my team will bring a name, I'll ask them what they do, what's the industry, because then my mind shifts to hopefully understanding those margins and trends and things going on. So absolutely, banks have access to a lot of data. And it used to be D&B long term. D&B is more kind of on the front end. But there's IBIS and internal reports. We leverage our capital markets divisions that they have typically people that just spend all their time in one industry. So we have the verticals. And so if somebody is, in logistics, you can go logistics vertical to understand. They'll know the trend of definitely, our United States. They'll probably know the global trend too. And they'll have articles on it. And so that will definitely help to shape the scope of, if somebody in my local market is having an issue and they're saying this is a industry-wide issue, I go to my industry specialist and he says, that's funny because I'm seeing the opposite from the big guys. Well, all of a sudden now you question of, all right, what's going on? That's another thing to navigate. It could be good and bad. It just then raises. But that data would help, especially public companies. It's all available. Will give you kind of a not a benchmark because they're the big guys, but at least understanding of the margins and trends. It won't be the same dollar amounts, of course, because they're big, but it understands how things work and ultimately what advantages, disadvantages they have to some of the smaller companies. Ultimately, then you have different reports that can give you what should be their days on hand, what should be their accounts payable, and banks have availability to all that. Really good bankers pull that. Some bankers who've been around it kind of know it. They know the local market. They may not know the bigger ones, having access, and the bigger banks may have more access to this. Covering nationwide or data on it certainly helps.
Got it. Understand. Okay. Let's close the loop on the risk assessment, Shawn, because you mentioned that there's some risk scoring that you do. I'm sure there's a file around that with applicants. So how is it scored, and where's the weighting of the score that you can share? When a bank looks at this, they're weighting certain factors of the business. How would you articulate the weighting of that scoring system so business owners, executives can kind of understand what you're looking at? And then part B of that would be what are some common red flags that make a bank hesitant to lend to a business?
It's that's probably I think also most banks, I don't say all banks, most banks use the MRA type system, and within that system, which produces a risk rating. You can pull different levers, some more conservative or less. It all goes back to what we talked about, and it starts with the cash flow. And typically they'll run, and I don't know the exact weight, we'll run a debt service coverage. We'll either run a based off EBITDA, depending if you have rent associated, and it could include the rent back, but it will factor in your debt profile, and the cash flow based off your debt you have today. It'll also pull the trends. So if your revenue is going up, it's to your advantage. If it's going down, disadvantage. What's interesting about that, if you're in an industry that is commodity based, a little bit tougher to navigate. And so maybe look at volumes versus sales, but I know it's probably minority. And then ultimately, margins. It does take in the leverage of the balance sheet, not so much the working capital. That's more of the collateral side of things. But those things are all weighted into what they produce as a risk rating. And there's typically a number associated. All banks are different. And the risk rating, what it's getting you is typically there's a number that's a pass credit rated at all banks. And if you're below it, you're better than, pass credit. And if you're above it, then that's when it's tough to get an approval. And ultimately you can potentially work your way back, but it's harder to do if you have a pass rating from once you get the historical financials, the process is much smoother. But then once you start diving into, you get your risk rating, the second piece is on the collateral. So for everybody, the best source of collateral is cash, if it's in form of CD or money market account or treasury. Typically then a lot of banks like the real estate, especially owner occupied real estate. And then where it gets a little more, dicey is the wrong word, but a little more risk to it is on the working capital. And then you have unsecured. So, and the working capital again is AR and inventory. Equipment's in there too, right below the mortgage. Harder assets are easier for a bank to lend, or to just say sell. And if they ever do, it's always less than the margin that we actually give you guys margins. So I wish we can say if we gave inventory 50%, usually you're selling it for 10 cents on the dollar. It's just a way to help navigate or mitigate the risk. So those two things go into your financial statements, produce a risk rating. The second is the collateral produces another one. You put those together, and that hopefully gets you a pass credit. If you're a pass credit, well, then it's important. If you're very stronger financials, you can actually get a more favorable rate, so a lower rate to the business owner. If you have poor financials, it's going to be higher. And the reason for that is the banks are regulated. And so we have loan review, we have the Fed review. And if you don't have a good Fed review, it could cause harm for the bank, potentially directly. And so they're trying to get the right assessment for a risk rating for a business owner, so that when loan review, which is internal, or Fed review, external picks it up, they can say, you know what, you bank, you got it right. It doesn't mean the credit's going to be performing or not performing. It just means all the material you had, you did your proper assessment, you got the accurate risk rating. Then you can proceed. And once you get what we perceive as an accurate risk rating, we do our best internally. You need to get your return from the bank. And I wish everybody's numbers will be, stellar, and you give very favorable risk ratings. We have the same margin. It's just not the case. It's across the gamut. And that's why you see fluctuations company to company is based off their risk rating. And usually banks are getting a very similar return on that.
Got it. Okay. No, that's interesting. Okay, so how now you talk about pre-existing relationships with a bank. How does that influence the credit assessment process? And what can businesses do to build a strong relationship with their bank?
This could be personal too, and Rich, you know me very well. I thrive on relationships, even if it doesn't include me. Like, meaning, like, if I can connect somebody to have a good relationship,
Yeah.
I really believe that's the way the world works. And it's even like if you're trying to get a job out of college, if you know somebody, have a relationship, right, you have more chance of getting a job. It's very similar once you start forging a relationship with the bank. And I would encourage, especially if somebody has the right vision, and there's no credit ask, it's probably the best time to start your relationship with the bank. Maybe small. What you're doing is they're starting your trust and building it, and having a story of where you're going with your company when you're talking with the bank. And starting very easy is great. And when you go for an ask for a big credit ask, or it could be a small credit ask, and you have a relationship, that should help you get a nudge to yes on a credit, versus if you just went blindly into somebody and you're early stage in your business cycle, it's harder to get it done. Not to say it can't be done, it's just harder. And so the more relationships you can have, not with ultimately, there's no right or wrong answer how many relationships you have with banks, but you definitely need one. If you had a couple, or at least it could be, if your bank that you had a relationship said no, maybe ask your CPA, do you know anybody else? I had a relationship, didn't work. That's okay. You can start it. For me, it's all about that. I actually, people who I don't, maybe this is where you weren't going, Richard, but it's probably worth saying just so people know. People can have good cash flow, good collateral. If you don't have a relationship or trust a person, I'm walking away. And the reason for that is businesses are run because of the people that are running it. And if you can't trust them or understand them or where they want to go, then it's hard to lend to them. And ultimately, fortunately, I've never been burned, but I believe one of my superpowers is assessing people, not just for credit, just as human beings. I think that's a very important skill set, and that goes back to relationship. Once you build and have trust, you have the character side, which is the biggest piece in my mind. That's not financial, and then you can go into those things that we've been talking about. That is tremendously important.
That's a drop the mic moment, Shawn. Well said. 100%. If there is a wisdom bite that comes out of this 1 hour together, it would be that. Well done. Well said. So, for the folks who are kind of grinding their business every day, what does, establishing a relationship with a banker mean? Where do they start? What do they do? What, appeals to you as a banker with over 2 decades of experience, right? How do they go out and do that? Because it may not be a natural progression for many business people.
Yeah, I actually think I think it's a foreign or uncomfortable because they may be fearful of banks. And I think, and not every banker is the same. So it could be a true assessment. Richard, you've been on that other side much more than I have, so you could probably attest. But I think it's important to find the right fit, and meaning there are a lot of banks. There's community banks, there's regional banks, there's the big money centers, and they're all great. And actually, and I face against all these banks as competition, right? That's my industry, and I tell everybody, I don't think we're the bank for you. I'm the banker. It's okay. Like there's plenty. I think being honest about that's important, but it's good to know. And I think what people don't know is what's the personality of banks, and they all have their kind of way. I share with people, even if it's competition we're facing, I try to be as transparent as I can. Definitely CPAs will know, CFOs will know, other business owners will know. Usually people, when they have a good experience, the CEO refer to another CEO. So I would say if a business owner is looking, kind of open up to their circle. And I hope to have an inner circle of people they can bounce stuff off of. If you don't, I encourage you to do that, even if it's not banking. You need to have a good circle for stuff. I think it will hopefully keep you, cons and pros, or keep you accountable in your own business. But definitely that's probably step one. If not, I think it's okay to go into a branch and start the conversations, and they'll ask questions so they know they get the right banker. What's your revenue size? Just so we know we get the right team in place. And so if you're 2 million of revenue, you may be in the branch, and that's great. If you're 10 million, you may get a business banker. And if your business is 50 million, you're going to get a commercial, or larger, you get a middle market banker. And they're all great. The difference is they all have different skill sets that will fit your profile. And you may start the relationship. Don't feel forced. Make sure it's a fit. And if you don't know what to ask for, I think it's okay to be honest. Or whatever you say, somebody, hey, I'm a small business owner, my business is going great, I need advice and help. And that, I'd rather have somebody say that than just try to slip something through, and then that's very choppy. Now I'm trying to circle back. Think I'm dealing with somebody maybe a little more sophisticated, but it's okay. The banker should be sophisticated and help you navigate the banking world. You need to know your business and how that operates, and that's what we're going to keep diving into. So I think ask around. Hope your inner circle or family, friends, or even your CPA, your professionals will know. If not, I think walking into a branch or calling up, I think is totally acceptable. Just to give you a sense, somebody walks into a branch, I feel a little bit better, but I always want to make sure that they did not come from a place of they got declined for their banks. So when you go through that, I think it's okay saying, listen, this is my first place, or I'm shopping. Actually, I want to say the word shopping banks because that probably is another stigma. But I think I'm open to my relationship. I want a banker who knows my business and can help me grow. I think that's a fair statement to start saying.
That is awesome, Shawn. You're moving very naturally in our conversation, by the way. You're prefacing some of the areas I want to go to. So, look, I've been around many entrepreneurs, and a good chunk of them, as they should, believe in their business, got great vision, etc. But many of them have feared rejection. They're so, tied into what they want to do and intentional and everything else that they fear stepping forward and establishing a relationship with the bank for fear of rejection. What advice would you give to that type of business owner, entrepreneur, who has got the great ideas, probably high ego for the right reasons, etc., but then can't take the step forward because if they get a no based on early stage or financials, etc., it can blow them away. What would be your advice to establishing a relationship there?
I think it goes back to having the right banker, because I can almost solve every situation. It may not be me. It may be resources I have in the community that can help solve somebody. I think one of the missteps that could happen if there is a no is the why. Why is it no? And then help somebody get there. I think what could happen sometimes situations once you give a no, they'll end it, they'll go to the next spot. I would encourage business owners to really be open and honest, not for pushback, so that they understand how that bank was assessing it, and maybe they can help in the future change that. Meaning, maybe it's a balance sheet leverage, right? So they just need a little equity into it. And by the way, you could have equity, which I know people want to give up a percentage of the company. I would also discourage that because it's the highest return. But maybe it's a form of family and friends debt again that's subordinated to the bank. So it's behind the bank in a position if there is a shortfall. But I think it's ultimately learning the why, because a lot of people have misconception. Banks are really there to help grow. And when things go bad, they expect them to pay for losses. And that's where banks are like a hard no. If you went for an ask and didn't get all the ask, maybe there's a way to get there and bridge. And I say bridge, not a year from now. Maybe you say, listen, I am growing fast and I want this XYZ is happening. I'm expanding. I'm going to a new line of line of business, same industry, just another piece of it. It could be whatever it is maybe it's just a bridge gap, and maybe it could be 3 or 6 months versus the year, the 12 months. And I think being patient how you do that is important, because the bank is trying to help you grow, but they're also not the risk takers that their return is less than entrepreneur. But I think there's a balance you can do together. If you get really aggressive, maybe it's equity. And I think that's where the rub comes with people of the no, what's equity versus bank debt. And I go back to banks have low margin and can, very low ability to lose. Like, you can have losses for banks. It's just not, unfortunately, it's just how thin the margins are for banks and regulated. So it's not like they can take risky loans. They could potentially risk their whole line of business, right? They could be stopped for months if they went through that. And I think people don't realize that because they just want their money. And I get it. Like, if I'm a business owner, you want your money, you want to grow, totally makes sense. But there's a balance there. Be a little bit patient. And if they don't get there, yes, by the way, and they get the why, then maybe they go to another bank and can help address the why before they have to start the conversation or open an application with that bank.
Got it. Wonderful. Okay. Let's talk a little bit about looking at external kind of environment rather than just insular, and how important it is for business owners to kind of understand the economy and bank regulation, etc. Because as they're approaching the need for, bank financing, they may need to understand certain regulatory requirements and how that impacts their credit worthiness. So just give a little bit of some advice on how do these requirements impact the way banks assess creditworthiness?
Another great question. I think gets lost, and it not lost from the banks. I think a lot of banks will look at the scope, but definitely the credit officer. They probably spend more time on the definitely the market factors you just mentioned and
Yep.
industry factors than maybe a relationship manager is more on the relationship, sales side of things. The credit team is talking about this daily. And I'll give you an example. Last year, the market was unstable, and inflation was a concern. Rates were going up drastically, and so one, you have market risk, which means you have rates are going up, and all of a sudden, people now for debt service coverage just borrow less because rates went from effectively 1% or 2% to now it's up to 6, so 3 times as much in a year time frame. And so now they can their cash flow can get less dollars than they did a year prior. So you have market risk, but then you have trends like when inflation was going up last year, the ability for consumers to have excess, a cash flow for stuff of leisure like retail. So retail was a very concern of, can people go to whatever, if I'm making it up, from movies to restaurants to whatever it was that wasn't part of their daily life. It wasn't part of, food, water, the mortgage. Those things are necessities. Is just more of how much cash do they have for stuff that are not essential. But then other big trends that have come up, and one of the biggest ones, which has been interesting to see, is the supply chain, and definitely what's happening with China. And those are maybe not regulation; it's more the politics, and then ultimately, it's geopolitical, and it's just the timing of things. So it may and this goes. I know pandemic definitely changed a lot of things, and ultimately having them hold money for extra cash and those things was a whole nother conversation to have with companies. And it's just time. It seems like things take a long time to get here, and ultimately that's another question to go through: is where do you get your supplies? Is it from China, India? Is it from somewhere else? Is it from the United States, Mexico? So it's understanding where that comes from, and then you have to understand that region. It could be some ag in South America. So like it's just, it brings in all these conversations that a well-rounded banker, definitely credit team know, and you got to stay on top of. I spend a lot of time with CNBC. Just even I'm not in the stocks or investments. I didn't know what's going on. And one, so I can help educate a business owner that doesn't apply to credit or banking, but then it may apply with things going on. Like this past week, job market came back more healthy than expected, so now rates are not going down. So I think a good banker knows that, can help. If you're a business owner, I know you don't have time. Download a good app. It doesn't have to be CNBC. It could be something else. It could be 5-10 minutes instead of or on the way to morning, may just Squawk Box on the radio or Bloomberg, whatever it could be. Something that just gives you some market intel or that gut feel of what's going on in the market can help you navigate your world, but ultimately understanding where the banks come from.
Wonderful. And just a part of that, Shawn, is, the banks put a squeeze, this was a number of years ago, particularly after the financial recession, on, reserves and all that kind of stuff. That type of macro factor and an entrepreneur coming to the bank seeking financing of some sort, what are the type of things that they should be considering? When that happens in the
Yeah.
kind of macro environment, it's going to impact their ability to, raise some funding via lending or so forth. What would be your kind of wisdom bite there that they should be looking for?
It goes back to, and this is a hard, I don't have an answer for it. It's the art in a business owner managing their balance sheet.
Yeah.
The lower leverage you have, right, which is not in favor for me to give you debt, by the way, but I like low leverage for a business owner because then they have ability for cushions when stuff happens.
Yep.
If things go bad, but they have good financial matrix, the ones we've talked about, there may be a way to get more capital from a bank to help bridge the working capital cycle. For example, supply chain went all of a sudden from 2 months to now 3 months or 4 months, whatever it is, or we're getting pressure from our client. All of a sudden, instead of getting 30 days, we're getting 90. And that could be for various reasons. Ultimately, if you don't have leverage in that relationship, they may push back, and you have to figure out how to say yes. I think is talking to a bank to see where they can get to. Then after that, as a business owner, you need to figure it out. And it could be you don't do the sale, right? It could be that to that point. It shouldn't be worth, if you can't make the factory work, whatever you're selling, it may be a no, because you don't want to risk keep growing, for example, during a time of a downturn in an economy. Maybe it is, hey, let's just stay, decrease 10% or stay level. I think you have to understand what can you pull back so you're not just leveraging, cash. And that is a hard thing to do, especially an entrepreneur who loves the growth. I think when macro happens, or after a financial recession in 09, things crumbled, and that was a lot of the regulation. I think probably the most important I've seen in my time of the Dodd-Frank Act and what it changed, and mainly for mortgage, but it crushed we had a recession in the economy. That it was a pullback moment. I mean, there's opportunities to move, hit the gas at some point when things start to come around. But if you hit it too fast, you maybe pull your stuff out of business. And that is a very hard thing, I think, for entrepreneurs to take a real look in the mirror of how do I navigate that? And I don't know the right or wrong answer there. That is the art and why people can get through it. I think dealing with the right people who can make decisions like that and have the backbone to do it, applaud them, and that's how they get through it. And then when they come through it, typically, what we saw after 09, companies really excelled. After the pandemic, company had some of their best years ever, but they were able to manage through some choppy waters, and it took hard decisions to do it. Not just the bank; it really took them. They had to cut their employees. Somebody who's been with them for 20, 30 years, or had to be, let's not invest in equipment. Let's put that on hold for 6 or 12 months. Or it may be, hey, let's bring in a minority equity investor so they can give us cash and we can put that to use. By doing that, the owner is ultimately potentially taking chips off the table, but they're losing their future potential earnings at a low point in their financial cycle. So there's levers to pull. I think if they don't know their levers, their CPA is a good person, a good banker can help them. Again, leverage your inner circle, and they just may need to make some tough decisions that are unrelated to the bank.
Got it. Wonderful. Okay. All right. We'll touch on fees to the extent you can share this part. Shawn, so look, business owners should expect to pay interest, should expect to pay the principal down, depending on how, the terms of the loan are. What other fees should a business owner expect? Sometimes stuff that they may not expect, right? Like origination fees, etc. Just give, a handful of fees that they should expect to pay when securing some type of credit financing.
Yeah. So definitely interest, and interest can come form, if it's line of credit, it's variable, it's SOFR plus some spread, and that's your interest rate, combine the two. If it's a fixed rate, depending what it is, it could be, fixed rate or variable, or it could be variable to swap, and that's a different conversation, but ultimately you can have some fixed rate, and then ultimately the fee associated, definitely an upfront fee, depending what it is, again, and the ask. There could be, and I wouldn't expect this, but the bigger line you have, there could be an unused fee. There's definitely an unused fee if you have a asset baseline, so it's like 10 million and above in a line of credit, and that's because it's a lot of capital. In the event you do not borrow, the business owner does not borrow money, the bank is still putting a $10 million example. They have 10 million of capital they're putting to a side that there's a cost. And so in the event there's no borrowings, and they even have, I'm making up a number, 25 basis points on the use fee, the bank's typically losing money on that opportunity. And so I share that. I think a lot of people have a hard time when they don't borrow money, but it's because we're saying you can call us anytime and get the 10 million within your conditions to get it. In the event we didn't do that, then we say, you know what, we can't do it today because we lent that money out to somebody favorable. We can't give you your whole money. And that's why it's there. But I understand why people say, I'm not borrowing, I got to still pay. But that's the reason you have it available to you. And then those are probably the typical ones. They're if you have a line of credit, it's typically renewal fee. It's very simple thereafter. But those are the main. There are costs that are non-related to the bank, that are there, that are, again, and this goes back to some of the regulation. if you get a mortgage on your property or an occupied mortgage, you have an appraisal. So there's an appraisal fee for the appraiser, not the bank. There's an environmental, so your environmental fee, and then when you do it, there's title work and attorney. So there are costs associated with mortgage more so than when you have a line of credit or equipment. That's all banks, and again, regulated. Also, you want to perfect your lien, make sure you have clean title on it. Those are normal things that you would do on a personal. But I would say I think everybody gets hung up, and I get it, especially at big amounts on the rate, but banks should get some reward. And granted, I see both sides. So I'm the bank speaking, so I understand people like, man, this banker is saying. But I would share, if you understand the margin is small on a rate, and then the bank will ask typically for the banking relationship, which includes deposits and treasury, and there are fees associated with treasury depending on your size. That is super important for the bank because the margin is higher than 2% on those things. That can help make it worthwhile, mutual beneficial relationship than just issuing credit. A lot of banks don't like to issue credit because it's the least margin business in the bank. And so you look at your business, if you're just selling, they're not low cost leaders is the wrong term, but if you're selling very cheap margins, you wouldn't be in business either. And so there is a mutual relationship. And I just say that because I think a lot of people just want to use banks for the money, get the cheapest. Understand it is a relationship. And the more you can have a relationship with the bank, not only will you get more credit availability to you, you also get more favorable terms.
Yep.
And so it's sometimes a penny foolish for people, which I get the mindset, but it's not the right one, I think, long term with the bank.
Awesome. Awesome. Well done, Shawn. Thank you for that. All right, last few questions. Future trends. Has AI and any kind of emerging technology made its way into bank processes where they're assessing the credit worthiness of possible entrepreneurs, and businesses?
I think you probably have AI in every one of your podcasts now. It's like the trend, and it's happening. We already use AI today. Um,
Yeah.
just so business owners know, I think everybody has some form or sense, and that is if things are in your could be account or financials happens, they have alerts to say, hey, this could be an issue, and things come up. It also could be AI pulling data from things you've done on your credit report, and there could be an opportunity for expanding the relationship. So those things happen, but I think some things we've seen, which has been a very huge plus, not AI, but for technology, is like DocuSign. So the banks ultimately, I think more and more, all of them have it, not for everything. By the way, why they intentionally don't have it is know your client is a very important step.
Yes.
This goes back to the regulation of banks. And that's ultimately to make sure we don't have terrorist funds going through the systems. It makes sense. I know people hate it, but you got to ask, got to know, and that's part of our duty. But ultimately, those things are happening, including it's happening a little bit. I think it's happening more and more. Is if you submit your financial package today, it's typically through email or a database, or it could be hard copy. Eventually, the banks may ask you to do it, submit it directly to a site, and that site will then directly pull it and do a credit report and some enhancements. So those things are starting to happen. I can envision some banks, mainly the smaller ones or tech companies, will just have that, and that will be their credit process. I think most will take that and still have the creative side of how to structure things with banks or what's going on with the numbers, because the numbers could spit out something. It may not just be what happened in real life. There could be scenarios that just doesn't pick up from numbers. So I believe there's going to be all three of those tech companies only, and you have your number. And it's happening today, by the way, with if you have a small, if your car loan or a small unsecured loan or equity, there's some sites, there's actually some great ones today that you can get money within 2 days by doing that. The bigger stuff is where it gets a little more risky for banks, but I think there'll be some form of that soon. Personally, and maybe it's because I'm in it, is I think there's the art and optimal relationship, and having that number spit out very quickly in technology. I think it's coming.
Understood, but I don't think we'll ever get rid of the need for the relationship, because this is all, as you mentioned before, Shawn, based on trust. So, okay, all right. So, what are the common mistakes businesses make during the loan application process?
I think the first one, especially for small business owners, you mentioned in the beginning of the podcast, but try to mitigate for taxes, reduce taxes versus keep cash flow is probably number one, where people say, hey, but I have all this. Can you just add that back? We can't. It is in your tax returns. We may look at it and have it as a mitigant longer term, but we will do any risk ratings based off your cash flow. So if you're going for credit, talk to your CPA, manage between your reducing taxes that year. Maybe you can amortize some of the equipment, then expense it all in 1 year or whatever you're looking at. I think going back to we've kind of mentioned this, but it's probably worthwhile understanding equity versus bank debt. And I think when you knowing what the ask is, so understanding your ask, and there's ability for banks to support mostly everything, but that's not everything. And it gets to a point where understanding this should be equity, and that means is this is too risky for a bank, or it could be to fund payroll, which is not, that's what banks don't fund payroll, or it could be a venture they want to go that's a little more aggressive, doesn't have accretive cash flow day one, and the banks will pass. That's equity. I think having a balance to know what equity should look like and bank debt, I think is the art. So it's not there's clear, so I get it, but I think a lot of people push back saying, banks step up. No, this is not bank debt. I think also we mentioned two other things. These are worth repeating. Having inaccurate financials is almost like that's the big red flag. Then it starts, you can't trust what they're giving you. And then two, they don't know their numbers or their inefficient processes, whatever it is, it's all bad news. So, so those are probably the big three. I think where if I was a business owner, to do the right process, having last 3 years of your financials ready, prepared, and an interim, and understanding what they look like. If you don't talk to somebody before that may know, it could be a CPA, it could be a CFO or a business owner, and understanding your working capital. Like, you may not know exactly what that means, but what the terms you pay to your supplier, what you're collecting. I mean, start there. You don't have to know what the days on hand are. That the bank can do that. Just understand what that looks like before you kind of go on blindly. Banks to look at, by the way, is sustainability and scalability. So if you don't know how you can scale, or is your business sustainable, or even where I am in the business cycle, my mature, my growth, those things, if you don't know it, the bank's going to make a judgment. It'd be better if you shared directionally of where you're going. And I know you mentioned having a budget. I get it. It's hard for especially small business entrepreneurs to have a budget. I would tell you the middle-sized commercial, middle market, corporate, they all have a budget. They'll have your budget. They'll have a 5-year plan. They'll have ideas of how they want to get there. They'll understand their capital. I know the small business owners may not get there, but you need to understand why or where you want to get to, and then hopefully somebody can help you understand how to create a budget.
Got it. Wonderful, Shawn. Last question. What's your one parting advice for business looking to secure commercial financing from a bank?
I would, ultimately, we shared a lot about trust and relationships. I can't share enough. I've been doing it a long time, and within 5 minutes, I ask questions on calls, and you definitely know, is I will qualify people during that meeting. I can underwrite probably in 5 or 10 minutes if I have financials in front of me. I just don't, so I'm trying to get it. So I am asking questions to know I'll leave that meeting if there's a credit here or not opportunity. Granted, once we get those things, but there's questions that are asked, and it's ultimately, testing is the wrong word. We're trying to understand. And in understanding, if you give something that's from left field, or you don't know a very general answer, because they're softball, we're not asking. Maybe it goes back to your fear of talking to banks. We were asking high level stuff at this initial meeting, but we were trying to very quickly understand your business. And what I love was when people can fire back at me very quickly, not as a good conversation. Because when I know they understand their business, but right away I can tell how we can help or can't help them. And people who don't, it becomes a very more of a swerve of curve to get to there, versus somebody who knows their business and ultimately is trying to understand us, it'll be a very direct path. And not only am I personally, am I trying to assess the credit? I am definitely trying to understand the person. Um, Somebody shared a great advice. A good friend of mine, when I early years my banking career, is they always ask, "Would you lend money to this person?" If the answer is yes, you go to the next one. If this was your bank and your money, would you lend to them? Is that answer still yes? If the answer is yes, you still go to them. And then the last question is, if it's your last dollar, would you lend that person the money? If that's a yes, then you proceed. And I'm trying to figure out, I'm running it as like it's my bank. I'm granted, it's far from my bank. I take that responsibility and credibility. The bank is hiring me to do this. I feel responsible as a professional in the community to help the community. I'm doing my best. And I love lending money. I love giving money, foundation, right? Those things, love. But I'm trying to understand the person, the company very quickly as I can. And I'm trying to do it so I can be efficient with the process and fair to the business owner. If we are not the bank for them, I want to tell him and say, go here. Or I'd say, sometimes I'd be honest, like, you should not do this. Like, in my opinion, right? And you can't have that if it's not a great conversation back and forth. It's also not great if I'm asking very poor questions to understand their business, which there could be bankers that don't ask the right questions. You'd be like, you just wasted my hour, and I grasp that too. I try to be very direct and positive. I will tell you, as I'm oldest, by the way. I'm not old in the at least in the real world, but banking. I think banking world, I'm getting old. I've When I was very younger, I was very professional, and because I wanted to exceed where I was in my experience, and I try to work as hard as I can, and I still do, because I always perceived it wasn't just years of experience; it was how many hours you put during that time can equal. And so I said, you know what, I'm going to do 5 years experience, and that should be like 20 years of everybody else because I'm working that much harder. And I think I've gotten to that point, but I say that because I have all the actual experience, but now my personality could come out. And so I joke with people on calls. I couldn't do that, 2004, when I was trying to figure out, how to, I was trying to be a very professional, young man. Now I'm very just honest, and I hope people like it. Some people may hate it. It's okay. I'm not for everybody. The bank's not for everybody, but I have much more fun than I used to 20 years ago.
Well, it's dropping the guard and creating authentic relationships, Shawn. So I completely understand what you're saying. So is there one cut to the chase question in your bag of tricks? Is there one that you ask
I got to
in
share
your
the
mind,
secrets.
in your mind, in your mind, if you can share it, in your mind, that gets to the point and says, uh,
Man,
I'm sure or I'm not sure about this.
I feel like the seat got hotter. I'm in here. All right. I'm glad you share. My bag of tricks is, I think it's not a secret. I think within the first 5 minutes walking to wherever, or taking a tour, I'm really trying to build rapport at that point, because, and the bank, every bank I work for may or may not disagree. I want to know the man or woman I'm talking to understand their character more than their company. And I do that trying to build rapport, and, ask about family and what's important to them. And, and it may not be that serves as a question just to get to know them, but I'm trying to understand. And I do that. I've gotten better at it. Hopefully I've gotten better even with, friends and family, but I try to do that very quickly on that front end, because if I don't like the person, or like trust them is really what I'm trying to get to. I don't have to like everybody. Then it's hard to trust everything else after it. And I do that in the first 5 minutes. I believe my superpowers are assessing people in 5 minutes. I could be, I'm not wrong. I'm not 100%, but I think that's the thing. After that, there's not one question on the financials, because you ask one question and it leads to two other things. And that same question, the day after I talk to somebody else, it could be a different answer, leads to two other questions. But it's all solving to what we talked about here in this past hour or so of risk assessment. That's what I'm getting to. The good people do that in conversation. They don't just come and list 10 credit questions. I would probably stay away from that banker, by the way. That's not a relationship. That's you want to have more fluid conversation, because that person knows what they're talking about. But my secret is, first 5 minutes, I am trying to read the man or the woman in the room. And they're trying to read me, by the way. It's not like it's one-way street. They're trying to figure out who I am, or the bank team is. So it's all good.
Brilliant. Shawn, thank you so much. As I said, I've known you for close to a decade now. You're truly an anchor in the community. I followed your career and you're doing so much good things for, the younger generation as well as professionals and obviously for businesses who are looking for, bank services and financing. So really well done. It's always a pleasure to see you. You've got such a lovely way about you, Shawn. And
Congrats.
I know banks who, I'm sorry, businesses who partner with you do well, for sure.
Richard, I appreciate it. Thanks for having me. I wish, by the way, my second life, I come back with your voice and demeanor. It's like butter listening to you. But I appreciate what you're doing. I know a lot of companies you're helping too, and I've listened to your podcast. It covers the gamut. The last one I heard was on positive thinking, which is on the growth mindset, which is great. And then I heard one of going through a tough time in the financial and business side. So you're all over it. Good for you, and kudos. Appreciate you.
And hopefully this is a nudge for you to start your own. That's my quest.
One day we're going to get there.
All the very best, Shawn. Thank you again. That was tremendous. Well done.
Likewise.
Thank you.
Appreciate it, Richard. Take care.
Thanks. Bye-bye.